Yeah, so I just want to come on and talk about positions and everything. I haven't had much of a short vol position on lately. I've been playing this Tesla, or more accurately, it's been playing me. I've been hanging on to the short, and basically it's gone up every day. So that hasn't worked out so well. Let's take a quick look at the Tesla chart here. Um, and you can see this is basically the action. We got that big move. This situation. It's really since January, the beginning of January, we've gone from 490s all the way up to 968, and then you can see we had this down move, and then pretty much just trending back upward again. So I pared back my short, so it's very small but still on right now. The action we had today so far, price action, was a big pop on the open, and then it's pulled back a little bit, but it just has been going up, so that hasn't been working out so well for me. All right, and let's look at some other stocks in the news today. We had Lyft. After earnings is down a little bit. However, not that far off where it's been in recent history. If you look at the 10-day on Lyft, you can see it had this run up to earnings, and then it kind of gave it back, but still kind of hanging in there. I don't have any sort of opinion on if this is a buy or a sale here. The other one that was in the news, Bed Bath & Beyond, BBBY, with issues. So, meanwhile, in VIX land, VIX has pulled back a little bit as we've had a couple days of sell-offs. We are awaiting the Fed on deck today. If we go over to barchart.com here, we can take a look. I just want to see if my buddy has listed. Yeah, so we have the Fed coming on later today. Markets are poised for that. So FOMC member Marker speaks at 8:30 a.m., so that already happened. And then Fed Chair Powell testifies at 10 a.m. today. And that is looming large on a lot of people's minds. We also have crude oil inventories out at 10:30. And then a 10-year auction at 1 p.m., and then federal budget balance at 2 p.m. So we've got some economic data and information coming out that is a big deal. People are anxious to see what the Fed chair is going to say, particularly. But if we do look at the VIX, we have had an erosion of the VIX after the upward action. We've kind of just been slowly moving lower on the VIX. One strategy that seems to have been working well in this recent price action would be the Bullseye strategy. So let's close up on the Bullseye strategy for a second. Now, this is a strategy, I call it the Bullseye because you're targeting a strike where you think you're targeting a strike that's an at-the-money strike that is short days till expiration. And the reason we target this strike is because you're combining a few things to give you the most money when you sell something. So options that are close to expiration decay the most. A. B, we've got just the general downtrend in UVXY adding to that, and then and we've also we're selling a call naked, and so it's a little bit riskier than other trades, but you don't have another side of the spread that you're buying to offset it. So you're basically collecting the maximum amount of money. Now, for each call you sell, most importantly, you have to consider this shorting 100 shares of UVXY for each call you sell. But if we look at the money right now, in UVXY would be the 11th strike. UVXY trading 11.16 right now. And it's only 2 days till the front week expires, so I would look to target the 21 Feb expiration, and you could sell the 11 call at like 70 cents right now, 71 cents. And so the strategy is you sell that the money call about a week out, and then you wait. Now, if UVXY goes higher in that period, then you're going to roll this trade out. You're going to buy this call back and sell the next week call out right before expiration. If UVXY goes out under 11, then you're just going to collect that premium, and the next week you come in and you're going to target the next at the money call. And I have several friends who use this strategy religiously, and it definitely works. The downside of it is, of course, it requires a decent amount of capital. You want to make sure that you can withstand a big move in UVXY. So if you sell one of these calls, once again, you need to model it as if you're shorting 100 shares of UVXY, because that's what it becomes as this spikes. So this is going to require some capital, and I would not, if you're starting out, I would only maybe sell one call and watch how this plays out for you for a few months, depending on how much capital you have. This strategy, though, I have several friends who employ this day in and day out, month in, week out, and some people will even do a strip of options. So, for example, you sell the 10.5 call, the 11 call, the 11.5 call, the 12 call. Now, I was discussing with somebody the other day the advantages and disadvantages of this versus actually just shorting the stock, because shorting the stock, in a good market seems easy because you short the stock and you just leave it and it goes lower and lower. Whereas if you sell one of these calls, the most you can make is 70 cents. If you short the stock and it goes down $3, then you make $3. However, over the long term, selling these options, because this is premium, when you're selling the 11 call at 70 cents with UVXY 11.15 bid, right? So there's 55 cents premium in this option. So that's an extra 55 cents in fluff that you're collecting over a week's period of time, added on to the price of the underlying as the underlying moves lower. So over time, as you keep selling these calls each week, you're adding so much fluff that it essentially changes the cost basis of where you're selling UVXY as it moves lower. So it's almost as if each week UVXY here 11, it's almost as if you're selling UVXY at 12, and then next week it moves down to 10, then it's as if that week you're selling it at 11. And so over time, the premium in these options that you're selling is going to vastly add to your return. So it doesn't seem like a whole lot of premium because UVXY is down at this lower price. With a $40 UVXY, it seems to have more premium, but percentage-wise and capital cost-wise, it kind of evens out because you're not required to put up as much capital when UVXY is 11 to sell this call as you are when UVXY is 40 to sell the at-the-money call at 40. So it all kind of levels out in the end. Selling naked calls is a risky strategy, and I suggest that you are confident in your understanding of how much capital this is going to require and what your risks are. And once again, I would look at it as a worst-case scenario, and thus just consider each call as shorting 100 shares of stock. That way, you are looking at a worst-case scenario. And as options traders, we always want to know what the worst downside is, because surprisingly, in option trading life, the worst thing that could happen that you think might never happen tends to happen sometimes at the worst time. So there's that. The reason why I'm liking this Bullseye strategy right now is because contango levels are lower than they were before, but meaning that these products aren't decaying. UVXY isn't going down as quickly due to contango decay as it was a couple months ago. So employing the options decay, the theta for options decay, daily options decay as a little boost to your returns seems to make a lot of sense in this environment where contango is a little bit lower. Let's take a look at the VIX Central chart here for a second. To your returns seems to make a lot of sense. And we're showing contango back up to 2.8%. So that's the highest it's been in a little while. It'll be interesting to see if this can creep back up to 5% again, which would be pretty cool. Let's take a look and make sure I'm out of the way. No, I'm not out of the way. Okay, so chart looks pretty flat. Somebody was asking me a couple days ago, why is there this big bump up here in October? And the answer to that is I believe it's due to the U.S. elections, the added volatility associated with that U.S. election coming up. So today I would keep a close eye on what the Fed is doing. In Thinkorswim, I can pull up a little TV screen. If you go to the bottom on Thinkorswim, you can go to Trade TV and you can pull up CNBC. I don't want to put it on for more than a second because I don't want to get in trouble with YouTube for putting someone else's program on, but you can pull up CNBC in the U.S. for the Fed announcements and some analysis. I'm not a huge fan of CNBC, but it does have some analysis. My buddy Dr. J and Pete Najarian are on there sometimes, and they're cool. But I see CNBC as just being like they're just always pumping the market. They're obviously owned by big banks, and so everybody's got a bias. You just have to be aware that they have a bias like everybody else. All right, so what am I doing today? Well, I'm just back to Tesla, and I got into this thing where I was like just sitting there glued to the screen and just watching my money slowly dissolve. And sometimes you just have to break yourself away. Like I don't want to lock in a loss, and so I just sat there, and the loss got bigger and bigger. And this is a common thing that happens to us. I don't know where I got the opinion that this was going to go lower from, but I got an opinion that this was going to go lower, and I was stubborn with it, and it cost me some coin. And it's no good starting out the year losing a little bit of money. That's no fun. I can tell you from firsthand experience. And I've still got a chip on my shoulder about this one. So let me tell you what trades I actually had on. I had a pretty risky trade on, which was the front week. I bought put spreads in the front week. So, for example, I was long the Tesla's trading 778. I was long the Tesla 760, 755 put spread. Maybe it was the 765, 755 put spread, $10 put spread, and expiring this week, which I paid, I think, $275 for. And it slowly has just dissolved. Obviously, that put spread right now is out of the money. We're up above all those strikes right now. And so, it was, if we stay up here through Friday, and if I still had that position on, I could lose all the money I put into it. So, a little scary situation. Yesterday on the close, I was watching this, or not on the close, but toward the end of the day, there was a sell-off, and every sell-off seems to get bought. It felt like, we had this whoosh down move here, and it felt like, oh, we're finally selling off, and it got bought. See, same kind of thing seems to be happening today. We get a up move on the open, it sells off, and then they start to buy it back up again. So we'll see what happens. It seems like we've had several up days. It seems like stocks don't go up every day, but we've had several up days in a row. Now, I'm going against my own principles when I start picking direction in stocks, and it's something that I'm not good at, so I should stay away from it. So I have to kind of fight myself at times, trading-wise, with these things. And, I'm a bit stubborn. I've lost some money as this rolled up, and I stick to it because I don't want to lock in the loss. And like I said, I've taken off most of it. I was short like 35 deltas. 35 deltas meaning for every dollar this goes up, I lose 35, or every dollar goes down, I make 35. Now I'm down to being short 16 deltas. And my current position is I'm short the I'm short an out-of-the-money call spread. So it is the 28 Feb expiration of the 820-840 call spread. So it's a little bit higher than where we are right now, but we could easily get back up to 820 or 840 or even 900. I mean, this thing could definitely move. So, but at least it's a winner right now for me, and it's not like the put spread I had on, which expires in 2 days. This has a little bit of time left, and so I feel more comfortable having that particular. There's different ways you can get short a stock with options, and I feel a little bit more comfortable being short an out of the money call spread than being long an out of the money put spread, because if the stock stays right here, I'm ultimately a winner, whereas before I would ultimately have been a loser. The other thing, I did buy a put spread in March, expiring in 37 days. I bought this March 700 680 put spread. I paid $670 for it. So I do have an out of the money put spread that I bought as well. That it doesn't expire for 37 days. So there you have it. I'm still in the short. All right. Well, listen, thanks for watching today. I don't have a ton of content for you because I don't feel like volatility is in an area where anybody should go big either direction right now. We're kind of in a mid-range still, although I do like the idea of selling a couple calls for the Bullseye strategy. Hope that helps. Leave any questions or comments for me, and I will talk to you in the next one. Thanks for watching, folks. Have a great day.